entity's assets, all of its liabilities to outsiders, whatever is left behind in an entity after deducting all of its liabilities is what is called as equity interest. This, friends, has become a very key area of difference between Indian GAAP and Ind AS. And I'll take one example to clarify. Under Indian GAAP, we have gone by the legal form of the contract. If the legal form of the contract is shares, we have put it as a part of capital. We have taken it as a part of net worth. However, if the accounting answer says, sorry, it's not capital, it's not residual interest, then the answer is that that instrument becomes a liability instrument. A very classic example is preference shares. In India, we cannot have irredeemable preference shares, which means all companies that issue a preference share have to necessarily redeem the preference shares at the end of 10 years or 20 years in case of certain specific companies. Now, from the point of view of the company, let's look at the definitions for a preference share and conclude our assessment. Is a redeemable preference share an evidence of a residual interest? That is the preference shareholder going to get back his money after all external liabilities are paid out? Will they be at par with the equity shareholders? The answer is no. And that's the reason why they are preference shareholders and not equity shareholders. So a preference share does not meet the definition of equity. It's not the most subordinate. It does not have residual interest. In fact, if I now go back to my previous slide, a preference share is a contractual obligation to deliver cash. Right now, let's keep aside the convertible and those kind of situations. Let's only talk about simple redeemable preference share. A preference share necessarily obligates the company to repay that amount. And that's why it has preference over repayment in terms of capital. So a preference share under Ind AS becomes a financial liability, right? This comes back to the point that I made a few minutes back, which is look at only what is in the contract. Do not look at what is in the law, what is outside the contract to assess the definitions. Does the contract state you will have residual interest? If that answer is a no, then a preference share cannot be an equity instrument. It has to be a liability instrument. And the moment you do that, just think about it, friends, the impact it will have on the financial statements of a company. The net worth will go down. Sure, there's a question around, can you explain about participating preference shares? Right. Now, in a participating preference share, my understanding of the instrument, and maybe you can give more details on the chat window, is that the redemption is still a priority or still sees a preference over the equity shares, right? So they may get a share in the profits through dividends or through special dividends, but redemption is mandatory. Such an instrument typically has elements of both equity and debt. Those are what are called as compound instruments. And when we talk about compound instruments tomorrow, we have equity versus liability assessment. But broadly, you could have instruments which are either pure liability or pure equity, or have elements of equity and liability both. I hope that answers the question around participating preference shares. Right. So we've looked at definitions. Time for a short knowledge check.